Welcome to Chillin' 101. We hope this video helps.
You start by sizing and selecting a market. Set risk at 1%, 2% of your account so losses stay manageable. Once done, pick a liquid instrument with volume above 100K and tight spreads to reduce slippage. Then define a clear entry trigger, a break of structure, a pullback to support, or a moving average cross. Make sure to place a limit or market order based on that trigger, and immediately enter a stop-loss level to protect capital before you watch the price move. You now need active management to convert a good entry into profit. First, set stops and targets using ATR or a percentage so they reflect current volatility. This reduces random stop-outs. Once the first target hits, scale out, take 50% off to lock gains, move the stop to break-even, and trail the remainder. Make sure to trail with a volatility-based stop because tightening too early kills winners. Conversely, widening stops without reason increases drawdown unpredictably. You finish by exiting using your final target or a volatility-based trailing stop that captures the bulk of the move. If the market suddenly reverses, close cleanly, don't hope. That preserves capital for the next opportunity. If you see repeated losses, stop trading and audit your plan. Check position sizing, edge validity, and execution errors. Make sure to keep a trade log recording entry, exit, rationale, and emotion so you can fix behavioral or technical issues quickly.
Thanks for watching. Consider subscribing if we helped you.